Welcome back. My name is Sergey Modolewski. Today I got my partner Devin Noble with me as well. And we're going to be talking all about basically the roller coaster ride that we've been on since late 2022 and heading into 2023. It really feels like we've been up and down as far as expectations for home prices, interest rates, the economy in general. And that it feels like that's where we were in December, November. Inflation was trending down, mortgage rates were trending down, particularly on like 3-year, 5-year fixed rates. The whole narrative of higher for longer as far as interest rates were concerned was starting to dissipate a little bit. And then we got some January data coming out and expectations basically flip-flopped almost entirely.
Yeah, but don't you think it's kind of it's kind of exactly what you'd expect with a market that's so engaged. They're so they're so interested in every data point that comes out because everybody's feeling the pain right now. Everybody wants to see those rates start to come down, at least in Canada specifically, and especially if you're holding a variable rate mortgage. So everyone's putting so much behind that idea that rates will fall soon. And every time we get a nice little data point that suggests maybe it will come down, you start to see that sentiment push that way. Every time we get reminded it's not coming down that fast, well, there you go, it jumps right back up.
Yeah, there's no doubt. Well, you got these like two buckets of people, right? There's anybody who's looking to become a new homeowner, and then anybody who's already going through the roller coaster ride because they are a homeowner and they're carrying either a variable mortgage. Maybe they've got a mortgage that's coming up for maturity because they look at the lay of the land right now, and whether it's a 3-year fixed or a 5-year fixed, you're still hovering high 4s, low 5s. Like every time I see a GDP report come out, or you see a inflation print, I've never seen so many people vested in these outcomes as you would right now.
Yeah, don't you think the most recent GDP print though gives the Bank of Canada at least maybe 1 meeting, 2 meetings to suggest that they can hold this pause for now?
No doubt. Yeah. I find like you never want to become a prisoner of the moment. So every time one of these reports come out, whether it's got upside to rates or downside to rates, like if you're a bull, you're hanging on tight. If you're a bear, you're jumping on the opportunity to kind of claim your side. And yeah, I think the GDP print tells us that things slowed down towards the latter part of 2022. So end of Q3, which would be around September, October. No, I'm sorry, around late summer, early fall. And then things really basically stalled out completely in the last quarter of 2022. And that's what we saw, the 50, the 75, and the BP hikes at the end of that time period. So it's not surprising to see that's when the sentiment really deteriorated. But it feels like we're in a different place, doesn't it, in January?
Very different. Well, it's weird. I mean, we had such a swing in sentiment as soon as that Bank of Canada announcement of a pause. We started to get inflation data significantly trending down in Canada and the U.S. and buyers woke up. All of a sudden, you had people interested in looking at properties again. I think housing's up month over month from January to February. They're still down year over year, of course, but even just noticing that change, there's obviously way more interest in the property market, and it's so easily tied to that, better messaging coming out in terms of future rate expectations. I think we've seen a bit of a reversal, so almost a double reversal in that. Things got good for a bit, and then things are starting to swing back towards the higher for longer message. But it'd be interesting to see how the spring market plays out, because there were a fair number of people who reached out to get a decent amount of rate holds, budgets locked in for the next 3 to 4 months. So those folks will be able to capitalize on things with those rates when they did come down in January.
No doubt. I mean, we saw that downtrend in rates, but if we actually look at, you could feel it, right? Like we're in the industry, we're talking to a ton of consumers, we're working on pre-approvals. We saw a huge spike in consumer interest right around that turn of the year. And it's not shocking. I've pulled up an article here from Yahoo Finance, confirmation the average price of a GTA home rose to 1.1 million in February, up 5.5% from January. So that's a 5.5% month over month increase. I believe that's one of, or the largest on record. Still, we're down 18% from the peak of the market in the same month last year. So from Jan to February, we're down 18% from peak. So clearly there's some a sentiment shift going on right now. Hard to imagine that it doesn't also have something to do with potentially migration patterns, demographic changes, things like that. But that's a pretty stark contrast from what we saw in November, December to what we're now seeing in January.
Yeah, and I can never remember the statistics right off of the top of my head, but I'm pretty sure we're still at record low listings. So people are just
Yeah.
not selling their home, right?
Yeah. We're down
Okay, yeah, there it is.
41%.
Yeah,
Yeah.
so you've got no one selling their home who, unless they absolutely have to, or if they're, you know, making the
Mhm.
move themselves. We know that people are holding on for dear life. You know, people are the credit crunch is certainly coming down the pipeline. People are maxing out unsecured lines of credit. They're maxing out secured lines of credit. Then come the credit card spendings. Then it's, you know, any cash savings they can possibly get before they start to miss payments on their mortgage. And I think we're already seeing missed payments on credit cards and lines of credit, anything unsecured, start to spike. It's a pretty regular pattern when you do start to see credit default increase.
Yeah, I mean, there's clearly a ton of demand. Like you're seeing all this anecdotal evidence about prices, homes selling for over asking. But what was that asking price? Is it priced relative to market, or are people pricing below market value? And my general expectation, when you look at months of inventory, when you look at time it takes to sell the property, you're still seeing waning interest compared to peak market activity that we had seen. So it's better than Q3, Q4 of last year, but it pales in comparison still to like the peak frenzy that we saw back in January, February, early March of 2022. So it's all about having that context. And it makes you wonder though, right? Like even when you look at like consumer spending, sometimes I look at the data that comes out on consumer spending, it is shocking. It's shocking, right? Because rates have sort of been on an upward trajectory and then they took a more steep trajectory towards the end of last year. I have tons, you and I both have tons of conversation with consumers. Everyone's stretched. I don't care if you're making 60,000 a year or if you're making 250 a year, you're stretched. Lifestyle creep impacts everyone.
Yeah.
And, you know, typically that person making 250 has a mortgage, a car payment associated to that salary. So people stretch themselves in similar ways across the income spectrum. Hey, if you're enjoying this content, enjoying this format, particularly having Devin on, please hit that like button and subscribe so we can continue bringing this format and these concepts to you in the future. Thanks. And let's get back into it. What are people still doing spending on these large ticket consumer items? Right? It's not even grocery spend. It's not specifically eating out at restaurants. It's jumping into things like specifically what's driving a lot of that spending in the last 2 months is buying new vehicles. It's specifically large vehicles, SUVs, larger trucks, things like that. So the consumer seemingly hasn't adapted to what may turn out to be the new normal of higher interest rates and for a longer duration of time. How long
Yeah.
exactly? We're not sure, right? But it's wild to see, and that just leads into what you're talking about, potentially consumer delinquencies.
Do you not think though, we've had declining interest rates for so long. It's going to take a long time for mentality to shift away from that if the new reality is higher rates for longer. It's
There's no
such an
doubt.
it's such an addictive drug. Super low
Yeah.
interest, it's free money, you can do what you want with it, it's easier to pay for things. Makes
Yeah.
perfect
The
sense as to
reality
why
is,
everyone wants it.
yeah, like that segment of society that potentially will become delinquent or in the past has maybe leveraged their property to refinance. Like they've been thrown a life preserver anytime you get yourself into trouble. You know, speaking about my own personal experiences in life, it's like when I've done things to put myself into a jeopardized position, sometimes I had to deal with the fallout of that and take the lumps and take the lashes so that you really feel it. So you could let that reality sink in. It typically stops you from making that mistake, or it mitigates like the depth of the mistakes that you might make in the future, having learned from that experience.
Yeah, it's
Canadian
parenting
homeowners,
parenting 101. Let people
right?
make their own mistakes. Yeah.
Take the lumps, let kids fall, right? But as
Yeah.
adults, particularly as homeowners, for the last like 15 years, every time there's an economic event, and typically on every like 3 to 5 year cycle, you've seen that downtrend in rates. And you've seen people get some adjustment in how much of their equity they're able to borrow. So a little bit more leash, more leash. And, you know, in this cycle, people have been given just enough rope from which to hang themselves. Rates having absolutely bottomed and home prices appreciated so quickly, you had access to so much equity. So if you're a consumer who overspends, it was just too easy to tap that equity to give yourself a way out. And this market cycle is a little bit different, right? Like we're dealing with unsustainably high qualifying rates right now. And as people's home prices are coming down, they have less equity to tap, and it's harder to qualify for a mortgage. And that's leaving a lot of people with more or less no way out, or they got to lean on products with higher borrowing costs, less flexible repayments.
Yeah, and that's assuming they've got the equity in the home to actually utilize those. It wouldn't surprise me if rates stay this level for longer. We will see more and more individuals in those kinds of scenarios, rise to the top and actually either be forced to sell or, forced to make some really tough decisions when it comes to, what they do with their finances. It's just a matter of time. We're only now really feeling the cumulative effect of those, however many 4.25% worth of rate hikes over the last 12 months. It's going to take 6 or 7 months for the pain to really, rise to the top.
Yeah. Well, it's interesting, right? Like there's a few things we know are certain in life. It's like death, taxes, and that Canadians won't miss mortgage payments. By hook or by crook, people will find a way to continue making that payment and stay in that property.
Yeah.
So you've seen that like dearth of inventory, and obviously that's going to continue to drive prices in the near term. But it does sort of beg the question of like, how sustainable is this? If we don't see rates trend down for the first half and leaning into the second half of 2023, how long before many people are forced to actually put that property up? You look at some news releases. I'll pull one up in particular. We're seeing CIBC has now seen 20% of their total mortgage book. So that includes fixed and variable mortgages. 20% of all outstanding mortgages have now hit their trigger rates. That means that someone is no longer covering even the interest due on their mortgage payment.
Yeah, they're reaccumulating mortgage balance.
Yeah, it's a wild time. So 20% of that book of business is essentially every month accumulating a negative amortization. That's going to grow on a month-over-month basis while the Bank of Canada's overnight lending rate remains this high. And that balance will accumulate. And when that person's mortgage comes up for maturity, that balance will be added to their outstanding mortgage balance.
Yeah, and they get re-amortized back down to, whatever the amortization remaining should have been at the end of their term. So if they took a 30-year mortgage and 5 years goes by, because it's a 5-year variable term, they would have to recalculate their mortgage based on a 25-year amortization, factoring in the larger balance still outstanding at whatever the interest rates available at the time. Now, many will be able to get around that, assuming they still qualify. You just re-extend the amortization, you complete a refinance, and very likely you'll be going back out to a 30-year amortization to manage those higher payments. And you certainly hope that anyone who took that product is either kept employment or improved their personal income scenarios to be able to manage that change in payments. But for a lot of people, yeah, they may not be able to do that, and they'll be forced to make some tough decisions at renewal. And I can't imagine that CIBC is unique necessarily in the percentage of individuals in this particular scenario. They've maybe just been picked on in this particular article, but I can, of the 5 really big banks in Canada, I believe 4 of them have this exact product. So it's likely there's a lot more people than just the number that's reflected in CIBC's, book of business in this exact scenario.
Yeah, you've got 27% of mortgages above 35-year amortizations right now as well. So like when we talk about, what options are available to consumers to help mitigate credit delinquencies, give yourself a little bit more flexibility in making your mortgage and total credit repayment. Like those folks, if they chose to break out of that mortgage right now, they'd be relegated to taking on a 30-year amortization. So their mortgage payment would have a huge jump as a result of that change alone. Not to mention, obviously, heading into a higher interest rate as well. Because a lot of people, like we're seeing it month over month. We talked about this in the past. Every year, you have roughly 20% of the mortgage book that a bank is holding coming up for maturity. And anybody who took a mortgage term over the last 2 to 5 years saw interest rates in the, call it the high ones to, at most maybe like the low 3s. But most people, is it fair to say we're around like 2.5? give or
Yeah,
take.
anyone in the last 3 years? Yeah, anyone who took a 5-year back in 2018 was probably 3.25, maybe 3.5, depending on the bank they were working with. So yeah, they're all seeing rates at a minimum 2.5% higher.
Yeah. One thing that's interesting that we're seeing, typically banks, they have debt to service ratios. Basically, it means your housing payment can only make up, under typical circumstances, 39% of your gross income. And your total debt, which includes any car loans, credit cards, student loans, can be 44% of your gross income. Those are typical guidelines that banks try to adhere to. We're seeing a very, very different picture right now. Not unusual at all to see a bank stretch those ratios, specifically the gross debt service, which is your home payment, now stretches debt comfortably to 48. Is that fair to say? That's a common
Yeah,
approval on that?
for the most part, the gross debt service ratio gets ignored. The total debt service ratio, which factors in all of the car payments, credit card debt, everything, that's very comfortably at 48% right now. And like, think about it. I mean, I I consistently find it surprising, especially given the way that, for the most people, Canadians are not self-employed, we're employed, which means, what your gross pay is, but what hits your bank account is your net amount. And we're taxed relatively heavily in this country. So you've got a huge discrepancy between what you're allowed to borrow, because we're calculating it off this pre-tax figure. And now we're getting financing, lending options that are providing exceptions up to 48% of that figure. And I think about how many compromising positions you can find yourself in if you're stretching yourself that far, and also, still factoring in a number that isn't truly what hits your bank account. You really have to be managing personal finances well to take that kind of, leverage and still be able to comfortably meet your payments and make all the other obligations that come in life that aren't even included on a mortgage application. You've got kids, your daycare expenses, banks don't see that. So there's so many things that get lumped into that really maybe, shed light on why there's so many people accumulating credit card debt and other unsecured lines right now.
Well, you're seeing those delinquencies start to rise. There's still, like, mortgage delinquencies near record lows. You're not seeing anything meaningful there at all. But installment loans, massive jump. Auto loans, unsecured lines of credit, and credit cards, they're seeing a very quick surge in defaults. And you got to think, like, that's all taking place among a backdrop of record low unemployment. So we've yet to actually see the unemployment rate climb in any particular meaningful way. You're seeing new jobs created. Now, we are starting to see, though, some signs of fracture in the market. Like, temporary jobs have been declining since last June. We saw peak inflation. That's when temporary jobs started trending down. Part-time jobs started to plateau, but recently we've seen some pretty huge job prints, both in part-time and full-time jobs. But what happens when that does start to turn? And central bank surveys are starting to show that companies are investing less in equipment, less in growth. Typically, jobs come next. And what happens to delinquencies? What happens to the housing market? Do we end up seeing more inventory? That's going to really drive the direction of home prices moving forward in 2023.
I'll be curious. And correct me if you know differently. I think I read somewhere that of the jobs that Canada was adding, what the largest employer was the either provincial level or federal level governments, or companies that are either subsidized or owned by the government themselves, public sector stuff. So if public sector jobs, I'll be
employment growth.
I'm going to be really interested to see how this gets managed, because at some point the government has to be able to manage, cost versus services being provided. Typically, if you do see something go poorly with economy, you're going to see a lesser taxation. It means the government's got less revenue to be able to spend on these kinds of services. Do we see the government start to let go of some of those jobs to try and help to reduce costs? Because if we're still adding, the private sector is going to be way more conscious of profit and expenses. They'll be, I would have to imagine they'll be the first to cut, but I'm curious to see if the public sector does that as well.
I suspect not. No,
I mean, it's a hard message to send, right? These are your voters.
Yeah, and there's like I always think about life from the point of view of incentives. And like when you're the incumbent government, what incentive do you have to be cutting those jobs and potentially painting a more bleak picture of the economy, local or national economy? And particularly, not that there's an imminent election cycle, but we're trending in that direction. There's already a lot of sort of call it political pressure that we're seeing out there unrelated to jobs. Like, I don't know if now's the time to start making those cuts. While I think it would be a positive, I just don't anticipate that we're going to see that. So, you start to see cuts in particularly the tech sector. Like you're seeing this huge cut amongst white collar middle management workers in high paying industries. But, even in those industries, like I speak even from family experience, friends in my orbit, you get huge severance packages. As consumers, they continue to spend. They're still deploying money in the economy. Oftentimes, they're coming from dual income households, particularly homeowners. So they're able to sustain those home payments quite comfortably. We haven't had the blue collar recession yet. In fact, those jobs have continued to grow on a month over month, quarter over quarter basis. So my question is like, when do we stop spending at restaurants? When do we decelerate our spending on services, et cetera? And like the GDP print from last quarter actually showed a decelerating spend in some of those areas, in particular services. So you wonder at what point, like it seems pretty clear that the Bank of Canada does have some insight into what's happening. They did get out ahead of that GDP news by giving forward guidance about an impending rate pause. And while a ton of people were clowning them when we saw the CPI print, when we saw the jobs data, when you see the GDP print from last quarter, it does give you some indication that there is in fact a slowdown taking place and that there might be more data than just these headline prints that we're seeing that are driving that decision making.
Well, and I'm pretty sure, I don't know if it was Canada or the US, but they did acknowledge they have additional data that they're provided with that doesn't get released to, the general consumer. So there has to be additional, data points provided to them that are justifying the decisions. I was surprised to see them come out with any sort of forward guidance. I would have thought they would have preferred to avoid that after their, swing and miss in 2020 about interest rates staying super low for a long time. But they were certainly very clear that there was a conditional pause coming, and we'll test it this week with the Bank of Canada meeting. I think it's Wednesday about their rate policy.
All right, so I want to chat a little bit about sort of the change in rate expectation, what's happening in Canada, what's happening in the US, and like the divergence that's taking place as we speak. Tiff Macklem came out, he told us there's going to be a rate pause coming up after the most recent hike. I suspect he's going to stick to that, particularly with tomorrow's hike. And we'll see how long it lasts from there. But in the US, the expectations have changed in a really meaningful way. Previously, we had been expecting 25 basis point hikes between now and June, between the start of the year and June. Now the expectation is for 4 quarter basis point hikes to take place between now and then. And potentially that has rates topping out around 5.5%. So like, what does that divergence look like if in fact the Bank of Canada stays put at today's rate?
Yeah, I don't know. Historically, we've been closer than, a 1% gap between Canada's policy rate and the US's policy rate. Wouldn't surprise me if we pause for the next few months, but if the US does have to move rates again because their economy is just showing that much strength and inflation's not, coming down as much as they want it to, I'd have to guess that Canada does follow suit with a few, maybe 1 or 2 additional 25 beeps increases, just to be able to manage, the currency alone for no other reason. Even if we're not looking to tackle inflation, we can't have our currency, materially devalue against the US dollar, which it already has. I'm sure Canadians who are snowbirds living in Florida or Mexico right now certainly feeling the pinch. We're down significantly against both of those countries' currencies, and Mexico's rates are much higher than ours. So we're definitely in a position where the Bank of Canada is going to want to manage how far our currency falls.
I will say this though, like I hate to stick my neck out there too far, and by all means, if somebody disagrees, give me grief in the comments. But I do suspect that sure, you're adding jobs, but they're typically on the lower end of the pay spectrum. We are seeing numbers on a month over month basis show a stagnation in the number of hours worked. and in the hourly wage growth. So inflation's still high, but hourly wage growth has tapered off. And, I do sort of wonder how long will this momentum last? We thought there was quite a bit of momentum coming out of Q3 in Canada. And when we got the Q4 GDP report, we saw that, in fact, that wasn't the case. And the economy slowed down meaningfully. And I suspect that that's going to show itself more quickly than a lot of people expect in the US. There is one thing that had played out. It's like when we talk about fiscal stimulus, right? It could take so many forms. It could be transfer payments from the government. It could be subsidizing cost. The one thing that I think a lot of people miss is that, like in the US, for example, there was still stimulus at the end of last year. It just took the form of the federal government. I think it's the federal government responsible for basically emptying the oil spigots and reducing the price that consumers pay for the cost of oil. That's stimulus. If you're paying less for your energy expense, that's keeping more money in your pocket to go out and spend on consumer goods and services. In Canada in 2023, I benefit from this myself, but it is something that gives me a bit of cause for pause is, if you look at specifically childcare costs, the moment you start subsidizing childcare costs, getting down eventually over time to $10 a day for something like that, that puts, give or take, don't quote me on this, but like $700 to $800 a month of additional after-tax income back into a household's hands. That's going to feed into something. That is its own form of stimulus.
Is that per child?
Yes.
Wow. I mean, I don't disagree with that kind of stimulus, just personally. I think.
Oh, no,
I think
just to be clear, I don't either.
Yeah, we do need to find a way to incent. I mean, immigration policies are certainly helpful because they bring people in, they add to the workforce immediately. But, Canada suffers from this, and so do many other countries around the world. Managing population growth at a sustainable rate and finding ways to have, having kids that much more affordable, especially for young families who either have grown up here or have moved here over time. It is going to be a challenge, and population crisis can lead to a whole other sort of disaster.
No
So yeah, I mean, those kinds of stimulus, I only see those types of things increasing over the next 5 to 10 years, as opposed to, decreasing.
See, I agree. It serves a beneficial purpose, but given the environment that we're in, the challenges that the economy is dealing with right now, it's got this, I think the word's like ancillary effect. And what I mean is, if someone's childcare is particularly expensive, it becomes prohibitive. It disincentivizes the second person in the household to go back to work because childcare expense makes up such a high proportion of the after-tax income they otherwise would be making. So they end up staying home. And that shrinks the size of the labor force. In this case, we are creating the incentive for more people to get out into the labor market. And, well, I guess, in this case, that would be a beneficial thing, right? Because that'll bring more labor, into the market and reduce a little bit of the pressure that we see on rising wages. So I guess in that way, it serves actually a benefit, not a drawback.
I think though you're right in the sense of evaluating, because let's say it does put $700 to $800 a month in after-tax income directly in your pocket. What are the likelihoods that gets spent on, investments or something that's going to, help build for the future, as opposed to stuff that gets spent on maybe that's 4 more dinners at a restaurant or something else, over the course of a month. We just know that consumer patterns typically spend money that hits their bank accounts as opposed to saving it or investing it. So that is one of the downsides is, if you do have the government offsetting some of your, very critical costs, especially as a young family, that extra money in your pocket could be spent on, other things that just continue to add to inflation because it doesn't shrink the demand for some of those goods.
Yeah, it'll be interesting to see how, if we see the consumer prints sort of taper off and slow down and continue to decelerate in the months ahead, at what point we're now paused with Bank of Canada rate hikes. We saw a slowdown, pretty much flat, 0 GDP in Q4. If we have another flat print for Q1, at what point does it create an environment where the Bank of Canada could start considering a potential rate cut? And, assuming that slowdown also takes place in the US, maybe that gives them justification for a pause. So I'm curious, will we potentially see a cut towards the latter part of the year? And what's that going to mean for the housing market? what should consumers be thinking about right now if they're on the fence about jumping into the market,
Yeah, that's a loaded question. I don't know. I mean, there's so many considerations. Like right now, we're seeing people hold on to their homes. We know that there are very few listings. We do know there's a fair bit of demand because people still want to buy. I mean, rents are consistently going up and up and up. We are consistently reminded of the number of people coming into Canada through immigration policies, and you're going to have, I think it's like 800,000 people they're trying to get into the country this year, and something similar next year. I mean, where are these people going to
between
live?
permanent, non-permanent residents.
Yeah. So like, where do these people settle? Where do they? We don't. I mean, what we don't do anymore. I mean, these are policies back from like the 40s and 50s. We used to incentivize people to go to parts of the country that were maybe, much lower population densities.
Growth.
Yeah, exactly. We used to hand away farmland in Alberta to families coming over from Europe. I think we're the predominant, group of immigrants coming over at the time that moved out to Alberta and got enormous plots of farmland, and they stumbled on oil. So they've all made some great money from that. But I certainly feel like those types of policies would help to spread out some of this population density and maybe help manage, home prices in places like, Toronto, Vancouver, those surrounding areas. Because if that's where population is headed consistently, time and time again, we're going to get stuck in this massive divergence between affordability in those major metropolitan areas and then affordability outside of them. And people are going to continue to, pay more and more for rent, and thus in turn pay more and more for housing in those cities. There's always that kind of logic baked into a buyer's mindset when they're out shopping is, well, we know people are coming in, and regardless of if rates stay like this, if we wait 5 years, there's just that much more demand for purchasing roughly the same number of homes. Toronto's not adding new detached homes at a rapid rate. We don't have land in Toronto to do that. We're adding condos. There's a lot of height going into things, but it's so costly to build. Development charges are through the roof. So for somebody to go and take down a detached home and put up a nice 4-story, stacked duplex, so you could have 2 families on one plot of land, ridiculously expensive, way too costly. Financing, especially at today's rates, are way too high. And you're just not going to see the return on that. So there's no incentive to do it. So we're not adding the type of density we need. We're not building new homes in the areas that people want to be buying. And more people keep coming to the city. So
yeah, it's a recipe to kind of buoy your rental expense, which again, between that constraint in building new homes, the number of people coming into the country and settling in certainly like some of the metropolitan areas and some of these other provinces as well, you'd imagine it's pretty easy to make sort of a bull case for home prices, especially as rates stagnate somewhere around these high 4s, low 5s. I suspect that later towards the end of this year, as inflation continues to trend down, barring any new geopolitical conflicts or anything like that, we're seeing all the recipe, particularly this last GDP print. There is a slowdown taking place in the economy. We've seen commodity prices trend back down in a very meaningful way. Natural gas trending back down, oil trading in this range of like $70 to $80 and getting stuck there. And food prices, my favorite thing right now, every week, is to go into the grocery store, and I'm on like pins and needles until I get into like the produce section to see how strawberries have changed and berries and broccoli and all that kind of stuff. And like, we're seeing a lot of positive signs. And if you look at the forward indicators, everything from fertilizer, shipping costs continue to crater, down 10% on global shipping prices since last week. We're now very close to pre-pandemic levels. And, the only thing that gives me a bit of cause for pause is like, you're seeing this big jump in credit impulse out of China. So you never know if the consumer there rebounds really aggressively. That could lead to some inflation. But, barring any big new geopolitical developments, I'm optimistic that inflation should continue to trend down. It may get sticky. It may get stuck around that 3.5%, 4% range. And that's why we're hearing this consistent message of higher for longer. But the idea of rates climbing up into the 6-7% range is just difficult to fathom that, given the environment that we're currently in. but you never know. And we'll keep everyone updated on any developments through this channel and future videos, and people can continue to make informed decisions about rates. But Deb, like, a lot of people are going to have mortgages that are coming up for maturity in the months ahead. You know, any advice for somebody who's sitting at a 274 mortgage? They're looking at their early renewal options right now at like 475 to 525. What should somebody be thinking about?
Yeah, I mean, if those are the renewal offers they're getting, they're pretty lucky. Most renewal offers are coming in high fives. I mean, for the most part, we've run the numbers on this. We've chatted about this, I don't know how many times on the channel as well. The early renewal offers really only make sense when you have much lower interest rates than the rate you're currently being offered to you. Taking a higher rate for, you know, as early as 6 months out of your maturity doesn't make a ton of sense. Get in touch with a mortgage broker, have them compare the renewal offer compared to what you're being or what's available on the market for your particular scenario. And there's tons of options. If you need help managing those payments, good. Look at extending amortizations, look at ways to, you know, perhaps reduce the mortgage balance on renewal if you've got some cash that you can, you know, make a lump sum prepayment with. But just be proactive. This is definitely the time where you want to be ahead of the game rather than late to the game. You can lock in rates as early as, you know, 5 months out from your renewal and not actually close until within those last 30 days of your existing term. And that can save you a ton of money right there. But yeah, be proactive, get in touch with a professional who can help you, you know, talk through the different options and really find out what your best plan is going forward. Speculating on rates is always tricky. You know, we're talking through 1, 2 year, 3 year, 4 year, 5 year new terms. People are still sometimes, you know, electing to take a variable rate. That's all dependent on the personal scenario. But you just want to be having the conversations. We're talking to tons of people who are maturing in, you know, September, October, November. And we're seeing an increase of, you know, people who have mortgages doing exactly what we're talking about, being proactive, making the phone calls, having the conversations, setting expectations now, and start to plan. There's zero harm in doing that, and you only stand to benefit from it.
All right, Deb, I think we're going to wrap it up. I think we've gone long enough for this week. You know, for anyone still watching, thank you very much. Thanks for tuning in. We're going to try to stick to a regimen of putting these videos out once a week on Sundays. We'll do our best. And in any case, if you've enjoyed this video, please hit that like, subscribe, so you keep getting this Canadian real estate and mortgage content. And we'll look forward to seeing you in the next one.